What have I told you since the first day you stepped into my office? There are three ways to make a living in this business: be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.
So we ended up the month of March, and man, we closed on a bit of weakness overall, looking at the different markets. So welcome back for another weekly market recap. And again, another tough week on my end. The week ahead was because of the bad weather. This week it was because of some technical issues with my PC. I just received a few replacements and I managed to install them. So things should be cool now. But without wasting any time, let's jump into the economic calendar. This week, I think, beside a few kind of relevant data points, but I think what we've seen in markets, it wasn't particularly news driven. I think it was more due from a technical standpoint. And then, of course, on top of it, we got Trump coming in with 25% tariffs on cars and automobiles production. So that might have played a role, but more on that later on. So as for the US, what was kind of important to follow up this week was the PMI coming out on Monday, which of course we don't have the data here, which is why I brought up this other calendar in here, where you can see that basically the manufacturing came in very, very lower compared to the previous read and the forecast as well. But services, all in all, they held up relatively well. They actually beat expectations and they came in above the previous read. So again, a bit tiny dichotomy there, but always remember the majority of the US economy, it's represented by the services. So you always need to be a bit nimble when you judge these data points coming in, right? Then moving on, what we got on Tuesday, I wasn't that interested in these data right here, like different Fed people talking, but what I was looking for was these conference board consumer confidence type of data, and it came in lower, not only lower than the previous read, but lower than expected. So again, another type of sentiment indication, which is going south a bit. It looks like the current theme in the market over the last 1 month and a half, 2 months, and it keeps on being present, and not only present but relevant because at the end of it, people might take actions just based on what they feel. We do know that when volatility picks up the pace, uh, we tend to see people getting emotional and impulsive. So it all ties in together, right? Uh, then moving on again, on Wednesday, we got data about the durable goods orders. I usually don't follow it a lot, but it's still a good indication of on where the economy it might go. Because of course, if you are very confident in the economy, mid to long term, it's much easier that you're gonna purchase durable goods. That it could be cars, it could be stuff that you put in your house, like refrigerators or I don't know, stuff like that. If you're not particularly confident, you might hold on a bit on those purchases, especially because usually they are made by taking out loans. So it could be another good indication of the current state of the economy and how the consumers are actually acting right now. But it's not something that I follow particularly closely, right? On Thursday, we got the usual jobless claims. It didn't really deviate a lot from the previous read, as far as I can tell. And even the 4 week average stayed pretty much where it was. Not a not a major deviation there. We also know that it was kind of the talk of the hour for 1 week, but the GDP it's now forecasted around 2.3%. Although, if you check the Atlanta Fed GDP now, it looks like it's set up to plunge. We'll see about that. I mean, it wouldn't be a massive surprise to see GDP coming in negative at a point, right? Still, that was a massive move in that indicator right there, or in that estimate, if you want to call it that. We'll see about that. We are pretty close to have the final data at this point. It's some matter of days, if not weeks. So we'll see what comes out of it. I think, maybe it will end up being not so dire as it might seem right now, but just wait and see. Okay. I don't feel like I might be able to judge with a lot of accuracy on it. So for now, I'll just take the data as they come at face value for these particular data set. Right. Then Friday was, of course, PCE data day. And at the end of it, PC, both the headline and the core, they came in line with what was expected. And even the rest, I mean, if you look at personal spending, it was negative the previous read, and still it kept on being negative. So not a major change, if not a kind of a confirmation of trend. And sadly, to the downside in this case, personal income, although it was negative on the previous data point, this time around actually came in positive and decently above expectations. So I don't know. I still think these data are particularly, to me, they're too volatile to actually make a good assessment. And again, it's always about the trend, right? One data point, it's not gonna make night or day difference in my view. So just follow the trend. It's a better tell overall in my view. So I think there's something else. Well, we got the Michigan consumer sentiment and another one which was previously at 64, almost 65, was forecasted at 58, came in at 57. So yeah, not a huge drop compared to expectations, but definitely a good drop compared to the previous read. So another sentiment indicator, which is telling us consumers are not feeling particularly good, at least from an emotional standpoint, from a psychological standpoint and whatnot. Now, with that out of the way, let's jump into some charts and let's start out with the DXY as usual. At the end of it, we were expecting a bounce in the DXY since 2 weeks ago. Looks like we had it. Was kind of accurate if you check where the relief rally, so to speak, if you want to call it that, actually stopped. This level, it's still one of those that you can derive from the macro range that I usually refer to. So we bounced off of the EQ, getting back to the other relevant level, which is basically kind of splitting the overall range in quadrant, right? You got your range high, your range low, your EQ, and both the upper and the lower sections can be further divided in other two subsections if you wish. So that's the kind of range in which we moved. And it looks like, it kind of nailed the move particularly accurately. If you check in the past, it was kind of the same. I mean, this level right here was relevant, let's say, in here, and then in here, and in here. Then it was flipped. And of course, this time around, again, it came back to be relevant. Kind of like in here, right? It was violated, was retested, and it provided the reaction. Same, was violated sharply. The market reaccumulated below a little bit, got stable, came back to test it. And when it tested it, it was a good reaction in here. So conversely, you could expect the other currencies to perform kind of specularly, right? So the euro opened up the week coming down a bit, but the last 2 days we've seen a bit of a bounce. The pound, it's just in a consolidation right now, not a lot. Don't really have a lot to say on it. In beside the fact that it's probably gonna follow what the euro does. They're very closely correlated. Although, again, the pound to me is showing a bit of a relative strength compared to the euro. So still keep that in mind. The yen managed to pull back into this old apex. And from there, we just grinded lower. So very ordered pullback. I think we might see a bit more of a consolidation in the yen if unless something really huge comes out from, say, the Bank of Japan, I guess. But I'm not really seeing it on the horizon for now. So I wouldn't expect a lot of movements into currencies for now, considering that we got this massive sharp move recently. So a bit more of a consolidation, or that would be my main disposition for now. So the dollar Canadian, or Canadian dollar, it's still kind of the same. Although, the more you don't have continuation to the downside here, the more the case for, a bit of a secondary attempt to the upside might unfold itself. Because, if you got a failure and then you see price getting back into what at this point you could consider an apex, it tests it once, twice, three times, and you don't get continuation. If you don't get it, if price cannot sustain the down move at a point, it will need to seek liquidity on the other side. So um, we are still operating in a range, but the more it can hold up, the more you might see it at least trying uh, for another push into the old apex. Let's put it this way. But still, again, I'm particularly neutral on currencies for now. Moving on, BRICS, again, it's just one and the same. I mean, not not really spend time on it. No, I mean, you just look at the chart and you can see what happened. Uh, in the grand scheme of things, if you zoom out a little bit, nothing really changed like massively or substantially. So I'll just leave it at that. Yields in the US, we were looking at this kind of a range. Not broken out of this yet, both for the long end, the medium end, and the short end. So again, still maintain my disposition of neutrality for now, at least on a very short-term period of time. Of course, my main thesis of lower yields in the future, that's still intact for now. But on a week by week base, I'm still thinking for now they're just in a dealing range. We got the sharp move down, especially in the long end. We drew back all of it. We came back into this apex, and I think we tested this point of release right here. Yeah, we tested it, and we got what you expect: sharp reaction. The medium end didn't really tap into the apex, but it just followed the rest. And the short end, it was even weaker in this case, which conversely it should mean that treasuries on the short duration should have a much more bullish posture. And that's what you see. See here, if you look at the previous kind of a dealing range right here, it looks like we finally managed to break above, at least we opened above this level, but then we spend the rest of the day getting back into it and retesting it. We closed on a little bit of a bounce, so who knows? Maybe we might try. Probably not to push up right away, but maybe getting a bit more stable, trying to accumulate and kind of confirming this flip, while the rest of the curve it's lagging a bit. But again, I guess there is really no surprise there. Short-term rates are moving a bit in anticipation compared to the rest of the curve, which is mainly because you continuously hear, policymakers jumping from one thing to the next. Oh, inflation is a problem. Yeah, but even employment is a problem. Unemployment is a problem. So which one are you going to deal with first? Because you still have that quote unquote dual mandate. So what happens when you realize you cannot really fulfill neither of the two? And I guess that's what it's keeping the market struggling a little bit in trying to assess what the economic regime might be, what interest rates should do, and how the Fed will react to it and whatnot. So again, a bit of uncertainty all across the board. Let's check oil. Now, if you remember, we were saying maybe it's time to be uh, a bit less bearish on oil, considering where we are getting into. And of course, last week we had the bounce, and this week the bounce was actually extended a bit more to the upside. We retested into this point of release, and basically in the upper section of the fractal, which originated a down move to those targets that we had in mind for the last, I don't know, few months at this point. So now it's interesting because what's going to happen? Now, we feel the inefficient segment in here, and then we retested it. We confirmed, kinda, yeah, the flip almost to the T, and we pumped off of it, and now we closed right back into it. Um, I think, well, even if you want, just erase this pseudo market efficiency paradigm type of bullshit. But if you just look at the structure, I think the oil for now would be neutral to me. All right, uh, could keep on climbing a bit higher, could just getting back and retesting back into this level, which at this point might be confirmed as a new created and established base. Who knows? But I I don't have one specific bias on oil right now. What I expected for oil almost already happened. So at this point, I would be more on the wait and see type of mode. At least if you want to assess it for the mid to long term. Intraday is gonna be all the different type of things you can imagine. Of course, that is just normal liquidity and market dynamics. But as for the overall direction, probably I would be neutral. As I said, I I wouldn't be short at this particular junction, but at the same time, if it was for me, I wouldn't have the huge confidence to be bull steep long in this asset yet. Now check the one which is particularly sure of what it wants to do, which is of course gold. Now, uh, I I don't think there is a lot to add. This chart is basically speaking for itself. Another sharp move to the upside with a gap as well. Now, I'm not sure because I didn't check throughout the week. So I'm not completely 100% sure that this gap right here, it's not due to the contract expiration and therefore the rollover. We might try to see if we do back adjust this chart, what's going to happen. Yeah, these, which is still a pretty sharp move to the upside, but of course you don't see the gap because now we just back adjusted the chart. Whatever you want to say about it, however you want to look at it, can't deny that we're still in a strong uptrend for gold, and it's actually trading particularly technically. It's respecting the levels. It's going up in a very ordered way. It goes up, and you see the extensions, the fill, and then another extension, another push to the upside. So the if a market closes particularly strong for the week, what you expect is continuation getting into next week. So might be a tiny pullback, and then we try to continue higher, beginning, the new month of April. So again, I'm still bullish enough on gold. Now, before going ahead, since I mentioned it, just remember that with the new month of April, we also do start out a new quarter. And although a few of those end of the quarter portfolio rebalancing stuff might have already happened, when you got these such large time periods starting out, you tend to have, I don't want to call it fuckery because it's not really, but you're going to have to see maybe a few erratic movements in markets because, people are trying to put on the positions they want to have for the next quarter. So again, don't be surprised if you're going to see a bit of choppy behavior getting into next week and possibly throughout the week. Now, of course, every single asset is going to be different. So gold might express this dynamic in a way because of the current posture it has. And some other markets like oil, it might express it in a different way. And some other asset as well, like Bitcoin in this case, might be totally different. So it shouldn't really change the overall macro direction. But intraday, especially if you do follow these markets and try to trade them intraday, bear in mind to not be so surprised if you might see the market being massively up in the London session and then completely down in New York. I think it's something which could happen, and it shouldn't be particularly strange to see in this period of the year and in this phase, the new quarter open. So just I just wanted to throw it out there. As for Bitcoin, I think at the end of it, we tried, right? We tried to basically pump, but at this point, it looks like the move was faded. So time to reassess, I guess. A few of the things I'm gonna say about Bitcoin could be also valid for the overall equity market because again, I keep on seeing them both as risk on assets. So naturally, with all the different nuances and whatnot, but in terms of what is driving them, which is again liquidity, I think that main driving factor will move and impact the same way, both in crypto and Bitcoin and the equity market. So first of all, I'd say the up move at the end, in the end, it was just a drawback. If these breakdown, it's now confirmed. And you can see that we came back down sharply and then we tried to kind of rally back on, kind of like this, right? I don't know. I mean, people might like it, might not like it, but that would be what? Your usual bearish flag, bear flag, whatever people call it these days. And then you see it breaking, and you know that at this point you should expect a bit more of downside. Um, I don't particularly, you know, put a lot of weight on that formation on any other formation that you can find in the encyclopedia of uh, chart patterns. I don't remember what's the title, but it was that book from Bulkowski, I think. I just think that overall, what we are going to see now is a bit more of a weaker price action in this segment. I think at this point, if you want to go beyond just the kind of 1 week prediction, if this whole move kind of falls apart, you should revisit the lows. I honestly don't see any other level which could hold up at this point because this one was already tested and we pumped off of it and now we're back to it again. So what? Might have a tiny bounce again. And if you see that one failing too, who's holding you from getting back to this region? 77, 78. I honestly think at that point we might crack it and getting back to 73, 72. All right. Doesn't have to happen all in 1 week. Probably won't happen in one blow, although, with Bitcoin, you never know. But I think this breakdown right here off of a move which was kind of it was kind of constructive in a way because we were coming back up in a very efficient way. But then if you see the failure, it kind of confirmed that it was just a drawback. So at this point, my disposition on Bitcoin would shift from neutral, as it was the prior 2 weeks, to a bit more bearish, which again doesn't mean it's going to crash in the next 24, 48 hours, but that's where I would lean toward, right, so to speak. And if you remember, we still have these potential bottom information, which is kind of still in play to some degree, although maybe a few squiggly lines might be already compromised. Let's see. On the RSI, maybe we would have to redraw it. On the stochastics, not so much. I mean, we could still getting back testing this trend line right here while price is making new lows. And therefore, if we can bottom out there, we would still confirm some sort of a divergence, a 3 drive in this case. For the RSI, we could see the indicator getting back even, up until the point it stays above 25, still have the potential. And overall, we would just feel completely the inefficient move to the upside, getting back into the 618 if you take the swing from, well, basically the swing which originated the up move. So this one right here, the overall movement started out from here in my view. So short-term bearish, but overall, I don't think it's necessarily completely done and forgotten. Your type of say goodbye to it, come back in 1 year type of bear market. Not yet. Sure, it's not particularly enticing, right? So not cool, but overall, pretty much all the markets we are looking at kind of traded the same. So I think coming into next week, I would be a bit more on the bearish side, although I might add a bit of a caveat there, but I'll save it for when we talk about the equity market, which, as usual, it's going to be in the canonic 3 seconds. Wait for it. So talking about stocks, equities, and whatnot, which is mainly, as usual, the indices, right? Uh, I think at the end of it, we kind of had what we were looking for. Because if you remember, the disposition coming into the week was a bit more of a bounce, and then we'll see what the final destination of this bounce might be. We started out the week actually bouncing because we also gapped up while the week was opening up, and we got basically Monday, Tuesday upside, and then a reversal on Wednesday, and Thursday, Friday was continuation lower. The Nasdaq was once again a bit weaker than, let's say, yes, and of course it's kind of always the same, but the Russell, it's always the weakest of all. The Dow still, holding up maybe a bit better even than the NQ, but I guess at the end of it, they are all moving together. Of course, you're going to have your relatively weaker and relatively stronger, but the overall direction should be kind of the same. So the point was we had that bounce. All right. Now we are checking the ETFs. We had that bounce and basically SPY traded back into the 200 days moving average, and it kind of retested the 21 exponential on a daily time frame. We actually traded slightly above it just for 1 day, but if you check closely, we never managed to open and close a daily candle above it. So it depends on your way of doing things, but for me, a moving average, even if you want to consider some sort of a dynamic support in this case, you consider that broken or reclaimed once not only you can trade in this case above it, but in my book you need to be able to open and close a daily candle above it. And then from there you might want to see another candle getting back into it, retesting it, and confirming that we are now below it, and we are probably going to live below it. So although we traded above it for a brief moment, the following three candles were particularly bearish. And again, confirming the Qs a bit weaker, they didn't even manage to get above it, but they've seen just a sharp rejection off of it. Again, from a moving average standpoint, it was bearish, and it was normal to get a bit of a stifle. No, is it? Don't get into terms that you don't know, Neil, please. A little bit of a sharp rejection on first retest, all right? And probably at the end of it, that played out the best it could have played out. I mean, you don't get something which is so precise very often. Because, it's kind of counterintuitive, I guess, because we have been called for a bounce for the last, 2 weeks? And it might seem to the most that at the end of it, this bounce, it wasn't a lot, right? And we are back to, bearish headline, the end of the world, recession fears and whatnot. But if you actually measure it, and let's take it, the SPY first, from the ultimate bottom to the top, it was what? Almost a 5% move. If you check the Qs from the bottom to the top, a 6% move. So that's kind of a tradable bounce, even if you are the type of guy which are holding positions for more than 1, 2, 3, 4, 5 days. Wasn't bad. And if you consider this is just the overall ATF, I'm sure if you then check the single stocks, there were tradable bounces in the single stocks as well. So just because maybe the bounce wasn't extended at those, to those degrees you were expecting, that doesn't mean that the setup wasn't actually a good one. Of course, it got back into the most logical area of rejection, and guess what? We did have a rejection. Same for the futures. I mean, the two charts, I still keep them both on, but they're kind of telling the same story. So what was interesting was this. If we zoom in, and now we are checking futures as usual, but here is where it gets interesting. We closed down last Friday with a good and strong move to the upside. Always be aware of how the market closes on a Friday, because if you check last Friday, the last hour of the day was particularly strong to the upside, all right, coming off the lows. And consequentially, we gapped up, opening up the week on Monday. And I'm just looking at the NASDAQ now, but you can see that basically it's the same over ES and the Dow futures, all right? So I'm just gonna be focused on one, but we can follow the rest, and it's kind of the same, okay? So Monday traded up, up we go. Then we go again Tuesday in here, a bit of, that was good actually. The Asian range was swept to the downside, and then we quickly reverted and going up for the rest of the day. So again, another up move for the day on Tuesday. And then we get to Wednesday right here. And you can see that right off the bat, we start to distribute, and then we just lost it all, and we completely plunge, right? And where were we on, basically Tuesday, Wednesday, if you check back? Oh, guess what? Tuesday, we retested back into here, and we basically got rejected on Wednesday. So you see that even intraday, if you got a few references from the higher time frame, you can kind of try to forecast what to expect, even intraday. And in this case, would have been, you know what, I don't think I'm going to keep on longing with a strong conviction, because we are now retesting an area of contention, and it might be that we are going to see what we just discussed so far. other than these, the market kept on going down for the following sessions. So Thursday was where I was a bit on the watch, because if you zoom out, now you see the weekly open, the gap up. We get back into it on a Thursday, and that's where I started to think, look, at the end of it, this move was really impulsive to the downside, and it's kind of prone to a bit of a drawback into it. So my disposition on Thursday was just, wait a minute, wait and see what happens. Because if we manage to just tap into the weekly open gap and actually hold it, we might get the opportunity to rally into the rest of the week. So the last basically 2 days, and closing on a strong note. The problem with that was, of course, that we couldn't. I mean, we tried to put together a bounce, but it was quickly faded. So, and it was just at the New York Open. So, yeah, you see that for the first hour of the session on Thursday, the market actually tried to rally both in NQ and in ES, right? And then it was quickly faded. The next hourly candle, it was just an engulfing. And from there, it was a snowball because it just kept on plunging into the weekly close. So this is where I said, you know what, if the bulls don't push it, it might be a bit difficult to keep on maintaining this posture. And now that we can see the close, same as we were saying for last Friday close, which was on a particularly strong side, especially the last hour, now we got the last trading hour of the Friday being particularly negative. Therefore, what you might expect is to see the market doing what? Well, the same it did last week. Just this time around, it might be on the, in the opposite direction. So to me right now, considering these markets, I would say the first part of the week, so your Monday, Tuesday, I'm expecting these markets to keep on going down. Probably we even gap down on a Monday. And now it depends how you do categorize the gap, because you might check the Sunday night opening up, but that's where the Asian session actually starts. And then you have the European session following up. So if you don't really follow the overnight trading, maybe you want to wait to establish if we gap down on the regular trading hours type of open. To me, it doesn't make a particular difference in the sense that if we gap down on the Sunday night gap, so to speak, I would still consider it a bit bearish. And then you might see the New York Open getting back up for a bounce, kind of filling in the weekly open gap and maybe taking out the overnight session high and keep on plunging. So that would be your ideal scenario for a continuation lower. The problem then would become lower to where exactly? I think overall, if we keep on going lower from here, you should start to look at, I don't know, for the Nasdaq, I would the first target would be this one right here, around 18,800, 18,900. For ES on the future chart would be, this is kind of tested already, so maybe even lower than that. So 5,400 even, something like it, around these lows. But again, keep in mind, might not happen Monday, Tuesday in one blow, but let's just say that's where I would start to look for, all right? And see if the market actually shows evidences and willingness to actually wanting to go there. Just because you might have an idea, it doesn't mean that it's going to play out in a matter of hours or at all, right? It's just a little bit of a disposition that you might want to have to establish some sort of a preliminary bias to kind of start to apply a bit of logic of, okay, what am I expecting? All right, is what I'm expecting being confirmed? buy the intraday price action. All right, I'm going to trade in that direction. Or wait, what I was expecting on a Saturday or a Sunday is actually being invalidated. Maybe I should start to look the other direction, right? Or maybe the market, it's not really decided yet. So if I'm trading with a directional bias and I'm hunting for directional moves, maybe this is not the market for me, right? So everything at the end of it should just help you to establish the course of action you might want to take getting into next week and navigating through next week. So the point where it might get a bit controversial, as I was anticipating while talking about Bitcoin and whatnot, is that if you remember 2 weeks ago, 1 week ago, when we were expecting these bounds, one of the, not caveat, but one of the specifications, so to speak, it was that we might see the market getting back near the current lows, right? And it might be we take them out. It might be that we create some sort of a double bottom, right? The point for me would be if we manage to take them out, but then you don't see follow through, all right? I'm coming to this from a standpoint of I'm bearish, okay? Let's say I'm bearish. My main disposition is that I'm bearish and I think we're going to have lower targets. How do I know if I'm going to be wrong on it navigating through next week? Well, it might be seeing the market actually going for new lows on both these two assets, which are the ones that I follow, uh, you know, uh, the most. But seeing the market actually stalling right below those lows, trying to put together a bottoming formation, which would be basically something like try to picture a daily candle. The market opens up on Monday, a daily candle goes below the lows. Then Tuesday you got maybe an inside bar, and on Wednesday you got a higher high on a daily base. And if that happens while you create a bit of divergence on the indicators, and overall let's say the momentum indicators would confirm still to be in a neutral, slightly bullish posture, at that point I might say, you know what? That was the chance the bears had to actually push this market lower. If they don't, or if they cannot manage to, and we are now forming these divergences, yeah, that's where at least I want to switch from full on bearish to neutral. Because then what you might expect is another bounce, price getting back again, testing into, I don't know, maybe these moving averages, or drawing back Friday's down leg a bit because it was particularly inefficient. But I would switch from massively bearish getting into the next week to, you know what, maybe we should wait a minute and try to look for shorts from much more advantageous levels, which means a bit higher than trying to short the actual breakdown. That would be my take on it. So I know it's a bit controversial. I know that, again, it looks like, yeah, so you're basically telling that the market could go massively down, but it could also just go down a bit, but then completely reverse throughout the week and actually working on another tiny bounce. Yeah, that's what I'm telling you, because that's what you should be prepared for. I mean, you should have a case for both direction and a case for no direction at all. So range bound environment. And you want to need, I mean, you need to be able to assess what you're going to do and how you're going to react to it and what your behavior and what your execution might be in all three different scenarios, because they're going to be different. And the way price is going to move based on which one it's going to manifest itself, it's going to be different intraday. So not only you need to assess the direction and what type of trades, either long or shorts, you might favor next week, but you do also want to assess what type of volatility to expect. And again, if we break and we got continuation to the downside, probably you're going to see a very sharp move. So in that case, you might want to say, you know what, the market is collapsing. This is when I want to holding to my shorts and trying to run them. But in the opposite scenario, let's say the market stalls a bit and it gets back in the range quickly. That's where you want to say, you know what, probably the market doesn't want to collapse. And it might be we got a range bound environment. That's where you don't want to hold to your trades and maybe you prefer to scalp them. So quick buck in and out quick with no directional bias at all. So this is why it's important to think about these things ahead of time so that Tuesday, Wednesday, or whatnot, you don't look at the charts like a muppet because you don't know what the fuck you are supposed to do in this market environment, right? That's the main point of it, right? Now, before ending up, let's check a bit what happened to the market relatively to volatility, and in this case, the VIX. Now, you see that while the market, I don't know if you're going to be able to see this dotted trend line right here. You know what? Let's make it solid just for the sake of clarity. It was a bit nicer dotted, but maybe it's just my OCD kicking in. So while the market was coming down, we've seen volatility grinding to the upside, and it was particularly sustained, right? And again, I still have the infamous 20 level marked off. So we were above the 20 level and we were coming up on the VIX while the market was coming down. So interestingly, as soon as the market actually broke off of this trend line right here, which is not perfect again, but it's more of a regression line if you want to call it that. So you see the market breaking it right when the VIX was breaking its own trend line basically. So was confirming a tiny bit of a top in the VIX, therefore volatility actually decreasing, which was what allowed the market to work on a bit of a low to put together a bounce. Interestingly, when you see the bounce, you see volatility going down, and when you see the market breaking this trend line right here, you see volatility actually breaking his relative trend line and getting back to the upside once again and getting back above the 20 level. So I know that the drawing it's not particularly accurate or precise or clear. Maybe let's see if we switch from the hourly to the daily time frame, it doesn't really change a lot, but you get the gist of it. So at the end of it, I think up until the point you see volatility being a bit higher than what you might expect, just be prepared for the market to be a bit more on the bearish side. Because usually volatility is high when the market is at least retracing a bit. And if we manage to draw a trend line from this point right here to this other one, so basically since what, middle of December till now, you see that volatility, it's not really something you see, but if you zoom out on this chart alone, you see volatility overall, it's trading at higher levels compared to what it was before. And if you extend it out in the past, like for instance in here, you see that overall there is this slow grinding, slow increase in volatility, and the spikes in volatility are getting a bit more frequent, right? So we are once again confirming the theme we were anticipating at the end of 2024, particular volatile market, probably diminished returns overall. For now, the playbook is playing out, so I wouldn't be so confident putting on long-term positions for now. Although, you know, there's also that saying that you need to buy when nobody else is willing to buy. That's where you make the money. But don't know if I completely subscribe to it. There was a huge discussion around the 10 best days of the year. I actually do have a chart for it. Maybe next time because I don't want to make the video too long. But you know, just a little bit of anticipation. In a nutshell, people say that if you miss out on the 10 best days of the year, which is basically when the market bottoms out and it got that sharp movement to the upside, which confirms the bottom. So if you can manage to buy while the market is doing that, you're actually capturing the best 10 days of the year, which is going to boost massively your portfolio performance on a year-to-year base. And it's true to some degree, but the bottom line is that if you actually smooth out the data over time, you see that most importantly, that actually participate in the 10 best days of the week, it's much more crucial to avoid the 10 worst days of the year. So avoiding, because the participating in them and so suffering that huge drawdown kills your portfolio performance even more than participating in 10 best days actually benefit that. So over time, even if you don't participate in the 10 best days, but if you can just avoid the 10 worst days of the year, you're going to perform even better. So probably going to bring up a few charts to give a bit of context to it. Just wanted to end up on that side note a bit, because it looks like everyone is constantly wondering, where is the bottom? Where is the bottom? When do I need to buy? Look, if there is someone out there which actually knows 100% for sure where and when the bottom is, first of all, I don't think it's going to tell you, right? Second of all, uh, probably you should ask maybe 20, 30 people on the planet. And you know how they know it? Because they are the ones moving the market. So, your classic Paul Tudor Jones, Warren Buffett, Druckenmiller, Jamie Dimon, and all these guys in the institutional world, right? Too bad Nancy Pelosi is not participating anymore in the game. Would have been wonderful to ask her. But well, I mean, I'm sure she's still participating, maybe not to the same degree she was before, but ah, just try to stay out of politics for once, right? Anyway, with that being said, the market, in my view, it's still in a very delicate situation, and I don't think, again, Trump actually helped the whole situation with these 25% tariffs on cars. Uh, I think overall, everyone knows that tariffs are not supposed to work out well for the overall economy and the financial markets. And the explanation is particularly evident. Tariffs is a tax on the importers, and therefore, at the end of it, it's going to increase the costs. If those costs cannot be passed on to consumers, they're going to hit and eat up the bottom line earnings for the companies. And therefore, since stocks evaluations are made on that price to earning ratio, I think what the market are it's basically struggle with now is that it is a ratio, but if you cannot assess what the E component, so the earnings component of it, it's going to be 3, 6 months down the road, it's very hard to then price the stock if you don't know off of what you should price that, right? So overall, these tariffs are gonna play a role, I think a negative one, and especially the fact that they are continuously on and off. Look, if you tell me I'm gonna implement these tariffs, that is done. I'm gonna keep them off. I'm gonna keep them on for 2 years. The market will price that in. We're able to adjust to it, and we might get to a more stable situation. But if you continuously go from tariffs on, tariffs off, tariffs on, tariffs off, the market doesn't know how to price that shit because you constantly change idea. All right. Funnily enough, I was reading on the internet. It looks like at the end of it, although these tariffs on auto are supposed to be a bit of a boost for the US manufacturers, it doesn't look so at the end of it, because it is true on one side that, for instance, Ford produces 80% of the cars that they sold on the US territory in the US. So they're not going to be subject to tariffs. And something like, Stellantis or General Motors, they are producing almost half of their cars in the US, and then they sell them out into the US. So again, 50% of their production are not going to be impacted by tariffs in this case. And ironically enough, Tesla is the one who should be, under this perspective, less impacted than anyone else, because almost the totality of Tesla cars are produced in, I guess it was Texas and probably California. So again, it might be that, sure, the tariffs are going to impact the US manufacturers as well as the foreigners, but it's even a bit worse than that, because although they might already produce a lot onto US soil, the problem is that a good chunk, like 1/3 of the components and the parts that they do need to assemble the finished product, the car, keeps on coming from foreigners. So if it is true that starting in May, these 25% tariffs are going to be implemented on auto parts as well, at that point, you're really going to impact the revenues of these car manufacturers. And I guess that's why the market reacted the way it reacted. So again, there was a bit of a technical component in what we've seen in markets, a bit of news event, and a bit of fundamental type of a component into it, which is why it's never one single answer, I think, in markets, and which is why it's sometimes it is just difficult to make sense of the most incredible moves you can see from one day to the next, right? And with that, I think I'm gonna leave you off. Have a fantastic weekend. Have a good Sunday. Be ready for Monday. Again, just a bit of a recap, expecting a little bit of volatility Monday, Tuesday, and then we'll see. Remember that next week we are going to have employment data, if I'm not mistaken. Probably I should have checked before recording, but I think we're going to see on Friday NFP, unemployment, and whatnot. So, and ahead of it, the usual ADP report, and probably Tuesday PMI, the ISM PMI. So again, there are reasons to see volatility in markets next week. That being said, be nice and be cool as usual. Nails out.
So, what you're telling me is that the music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.